One nice thing about these M&A transactions in terms of the way they're structured is that a lot of these deals in terms of the headline value will include some type of franking credit. So and in particular if it's an international buyer who doesn't have use for franking credits, a nice way for them to boost the value of the transaction, if you like, is to agree with the board to unlock some of the franking credits as part of the transaction. So that might look like a takeover bid at $1 might be structured as 50 cents of capital component and 50-cent fully franked dividend. That 50-cent fully franked dividend is then going to go ahead and release another 15-20 cents worth of inherent value in franking credits that for the right investor can be utilised in terms of if you're on zero tax rate, you're obviously getting a full refund in all likelihood for those franking credits. If you're on a 15% tax rate through a self-managed super fund, you're getting some of that money back. So I don't really believe in free lunches in financial markets, but at the moment, franking credits in some of these transactions are as close as you can get to a free lunch because the market doesn't price them. A lot of institutions and foreign shareholders don't have use for them, but in the hands of the right shareholder and the or underlying unit holder, they're inherently valuable. So we're not targeting that specifically, but if that's something that's on offer as part of the transaction, then it's definitely something that we're interested in participating in, and that's a pretty frequent trend in terms of the number of occurrences in the last 12 or 18 months. A good example of that, in terms of one of the best that we've seen in the past 12 months was a company called Seymour White. SWL was the ASX code. They received a takeover from an offshore player. From memory, the bid was around about $1.28, in terms of the cash value, but it was structured along the lines of approximately 38 cents or so of that was a fully franked dividend. So that 38-cent fully franked dividend grosses up to more like 50 or 51 cents of value, a little bit more. So the actual headline value of the transaction was more like $1.40 or so, maybe $1.42 on a grossed up basis, as opposed to the $1.28 headline value. From memory, the stock didn't trade above $1.28 throughout the whole process, even as it became fairly clear that the transaction would proceed, that people would receive the full scheme proceeds, including the dividend. So fairly late in the stage there. Obviously, keeping in mind 45-day franking requirement in terms of the holding period for these stocks, but you could literally buy the stock at maybe 125, 126, something like that, when you knew almost certainly the deal was proceeding, and effectively get $1.40 or so worth of grossed up value, within a couple of months of making the transaction. So that's one example from the past year, but there's probably 4 or 5. Life Healthcare, LHC was the code for that, was another one that was definitely structured in that way. And it's a bit of a common trend of late. So I think a free kick in a lot of ways, especially for a low tax vehicle such as a self-managed super fund in particular.